In this video, we're going to start our discussions about the dividend payout policy. Now, what I find a little bit strange, maybe strange is the wrong word, but what I find different is that when we talk about dividends, we always take the position as an investor, and a dividend is what we receive. In this context, though, we want to look differently. We want to think now about the management team. How does the management team look at the payout policy? From previous videos, we've come to the conclusion that the investment policy of the company and how we pay for things is a very important factor in the financing decision. And the fact that management prefers to use internally generated capital before any other source of financing. So management wants to use retained earnings. And of course, if retained earnings are very important and they want to use lots of retained earnings, that implies that they want to minimize dividends, or they want to use dividends in a very sparing way so as to maximize the amount of funds available to reinvest. So again, what does a company do with its free cash flow? It either pays it out, either dividends or repurchases shares, or it retains it. And of course, it uses that money to either invest in new projects or cash reserves. So the decision about financing is influenced, or actually, let me repeat that. The decision on how we finance influences how much dividends we actually want to use to pay out. They're combined. Just a couple of technical things before we get too far into some theory. There are four important dates. The declaration date, of course, when they say that there's going to be a dividend. In that declaration date, they tell us what the payable date is. When will the cash actually be paid? And then they also tell us what's referred to as the record date. An investor's name has to be on file on this date for them to be entitled to receive a dividend. Now, what happens is when people buy and sell stock, there is a time delay between the actual transaction and when that information is given to the corporation. It's a day or two. So for that reason, if you buy a stock a day before the record date, your name might not be in the file, so you will not get the dividend. So they have or constructed something called the ex-dividend date. And this ex-dividend date is typically 2 days prior to the record date. So if you want to receive the dividend, in this case, you have to buy the stock on November 15th or before. If you buy it on the 16th, you will not receive the dividend. Now, what happens on this ex-dividend date is that the price falls by the amount of the dividend. So net effect is you get the dividend of sorts in the form of a capital gain. If it's a $2 dividend, the price drops by $2, and that's what you would pay on the 16th. But the $2 that of the dividend would actually go to the old shareholder whose name is still on that date of record on that date. It's just a technical thing, importance, but it is obviously important. There are frequently things called special dividends. This is maybe at the end of a year. And maybe it's a dividend policy of the company. We're typically going to pay a very low dividend. Let's say we're only going to pay a 10-cent dividend. But at the end of the year, we take a look at how the company's done, and maybe we'll pay an extra dividend. So you could have something referred to as a special dividend. The special dividend, it's kind of like maybe a company says, like, we're always going to pay a very low dividend, say 10 cents. We're going to pay that every quarter. But at the end of the year, we'll take a look, see how we've done, and maybe we will pay a special dividend. The idea here is that you shouldn't expect to get that increased dividend every single term because you've been told it's always going to be 10 cents. Next, there's also something called a stock split, sometimes stock dividend. We'll talk about that in some detail when we get to some later videos. But this is where instead of giving cash, you're given shares of stock. We'll talk about that later. A return of capital is where instead of paying dividends out of retained earnings, we're actually going to pay it from other accounts like paid in capital, or we liquidate assets. So this is a different type of distribution, right? So has maybe some different rules. A liquidating dividend would be a return of capital to shareholders from maybe we terminate one of the divisions of our company. So an alternative way to pay cash to investors, though, is through a share repurchase or buyback. And this is essentially where we use cash to buy shares of our own outstanding stock. Now, this stock, as you're probably aware, becomes what's referred to as treasury stock. Treasury stock does not vote. It doesn't receive dividends. It is just held by the company, but it reduces the number of shares that are used in the calculations for earnings per share, etc. And how this is typically done is through what's referred to as an open market repurchase. You just go to the market and you buy back the stock at the current market price. And again, that's primarily the way this is done. Frequently, though, you might also see something called a tender offer. Essentially, we make an announcement to all the shareholders that we're going to buy back a special amount of stock, and maybe we set the price. And usually this price is set at a premium. So those people who really want to sell the stock anyhow, they might jump on this tender offer right away. So if the shareholders don't tender enough shares, the company could just cancel this offer and then no buyback occurs. But this is a way, obviously, to entice shareholders to sell this stock back. However, it's at a premium. Now, why you would want to do that instead of the open market repurchase, quite frankly, I'm not sure. But there are some other things that they could do. Sometimes they refer to things as a targeted repurchase. So maybe we are just going to go to a specific shareholder. Maybe a shareholder tells a major shareholder wants to liquidate. So they contact the company and they say, hey, look, I'd like to get rid of my stock. Why don't you guys just buy it all back from me? Now, green mail is a type of a targeted repurchase, but in this case, the company is trying to avoid a takeover. So again, there's a major shareholder who's trying to buy out the company. So they're going to buy out the shareholder. Typically, we're going to offer them a big premium over the current price. That way, the company can avoid this takeover of the company. So it sounds like it's a little on the shady side, and indeed, it kind of is. So let's think about the comparison of dividends and share repurchases. So the board's meeting to decide how to pay out $20 million in cash. Company has no debt. Its equity cost of capital is 12%. So with 10 million shares outstanding, they would be able to pay a $2 dividend immediately. The firm thinks it's going to generate future free cash flows of $48 million per year. So it anticipates paying a dividend of $4.80 each year thereafter. So we want to talk about what decision should they make. So let's talk about this concept of value, right? So cum dividend, this is when a stock trades before the ex-dividend date, right? So this is before that ex-dividend date is what we call the price that's cum dividend. It's the current dividend plus the present value of future dividends. So in this case, the stock is worth $42. After the ex-dividend date, again, the new buyer's not going to receive the current dividend, right? This is in between that time. So again, it's just going to be the 480 divided by 12. The stock price is $40. Again, the $2 difference is the value of that dividend. So suppose that instead of paying a dividend, they use the $20 million to repurchase some shares. So with an initial share price of $42, they would be able to repurchase 476,000 shares. That's $20 divided by $42 a share. That'll leave 9.5 to 4 million shares outstanding. So what does this do to value? So it shouldn't be surprising that this repurchase has no effect on the stock price. After the purchase, the future dividend is going to change. It's going to go to be 48 million divided by those shares is now $5.04 a share. Again, that price is $42 a share. So whether they do a dividend or whether they do a repurchase, in this example, there's no change in value to the firm. Now, in perfect capital markets, an open market share repurchase has no effect on stock price. So the stock price is the same before and after the cum dividend price payment or date, as if the dividend was actually paid. Now, what is the investor's preference? Again, in perfect capital market, investors are supposed to be indifferent between the firm distributing dividends, distributing funds by dividends or share repurchasing. So by reinvesting, of course, they can replicate their either payout they want. If they don't want a dividend, they could reinvest those dividends. If they wanted a dividend and the company wasn't paying, they could replicate that by paying out the dividend on their own, right? So they can create homemade dividends, if you will. So in the case of Genron, again, if this firm repurchases shares, again, we're going to talk about this homemade dividend, and the investor wants cash, the investor can raise cash by selling shares. That's their homemade dividend. If the firm pays a dividend and they would prefer stock, they just reinvest the dividends and purchase a different shares or additional shares. So there's a trade-off between current and future dividends. Again, now we're back to this Modigliani and Miller research team, and in this case, they're talking about dividend policy. If Genron pays a higher current dividend, future dividends will be lower. If they pays a lower dividend, future dividends are going to be higher. So regardless of what happens, the value should not change. So if they want to pay the dividend larger than $2 right now, but it only has $20 million in cash, then Genron needs an additional $28 million to pay the larger dividend. So they do this, they can raise cash by selling some new shares. So what happens? given the current price of 42 bucks, they'd have to raise 0.67 million shares. That increases it to 10.67 million shares. Let's find the new price. $4.50 is the dividend. Again, doing the math, we end up with a $42 dividend. Again, the share value is unchanged. So Modigliani and Miller talk about, regardless of what you do with the dividend, nothing happens to the value of the firm. So again, there is a trade-off between this future and current and future dividends. So Modigliani and Miller's dividend irrelevance concept says, in perfect capital markets, holding the investment policy of the firm fixed, the company's choice of dividend policy is irrelevant, and it does not affect the initial share price. Now, I will tell you that if you look at the real world, this just doesn't seem to make sense. If a company announces that it's going to increase the dividend, there is an increase in price. They do seem to have a connection. So again, Modigliani and Miller are talking about this perfect capital market, and we know that there are market imperfections. So in future videos, we're going to talk about what are those factors that really do have an influence maybe on share price. We're going to start trying to analyze why this Modigliani and Miller theory might actually sound correct. So the process in our last videos here is to say, look, what happens to the value of a stock when dividends change? Either it doesn't change, it goes up, or it goes down, right? There's only three choices. So we're going to start trying to understand a little bit more about this Modigliani and Miller process. Are there things in the marketplace that actually make this kind of make sense? So we'll talk about that in the next videos. See you in the next one.